So welcome everyone. This is a very popular webinar course on how to find the hottest real estate markets using data science. And this course is nothing short of magic. It's going to allow you to independently find the best cities in the US for real estate investing. By the time you finish the webinar, you'll be able to randomly pick up cities anywhere in the US, compare them, and then have complete knowledge of the diamonds and the clunkers. And you're going to be able to do this without paying anybody for a course or for a subscription. But just because the course is truly free, it doesn't mean that it's not worth millions. Over 25,000 investors have taken this webinar in some form or the other. I get dozens of fan mails about this course from all across the country. Billions in real estate, billions with a big B, have been purchased using the techniques shown in this course, and tens of millions in profits made, all using the simple and free techniques that you're about to learn. Before we do that, a little bit about what Anna and I do. So, speaking about myself, I'm a quirky, very opinionated data scientist. Anna and I build and buy real estate throughout the US. So, we have over 800 very nerdy, data driven investors. They've been kind enough to give us $250 million of their money. So our team and I have used our data science techniques to exploit a lot of blind spots in the US real estate markets. And we've used that money to buy or build a portfolio of 31 projects, which have nearly $1 billion in completed value. And our data science journey has taken us to 17 metros across the US, all handpicked using the principles in today's course. And these properties, they're in unknown cities with names like Lithonia and Dalton and Fayetteville and Greenville, and so many of them, not all, have been blockbuster successes. Why? Data science. Yes, the number one job in America today that every billion-dollar company is hiring for. Did you know it's the best paying job in America? Why? Because it can create astonishing amounts of wealth for companies and also for you. And sometimes, by the way, I don't find anything to buy in the cities that data science points us to. And then Anna and I end up building them. Multifamily projects, built to rent projects, industrial projects, townhomes, you name it, we've built it. And we've had absolutely mind boggling success. No Grocapitus investors ever lost money. And our last 4 projects have had an average annualized return, IRR, of 49.8%. Those are actual investor returns in our last 4 projects sold. And remember, I didn't cherry pick. These are just the last 4. While thousands of hours went into buying and improving and selling these projects, the biggest reason for this kind of blockbuster success, data science. And our geeky, nerdy investors absolutely adore our data science. For example, Sarah, she's invested with us 4 times. We've now sold 2 projects. Just take a quick look at this orange section and then this orange section. And it tells you everything you need to know about Grocapitus. All right, let's get started. But before we get to the amazing data science content, here's the really boring stuff that my lawyer forces upon you. Because this is an educational webinar, it doesn't squeeze out the risk in real estate investing. My recommendations are not magic. I just feel that they're magical. These are personal opinions, actually. Do your own due diligence, consult professionals, and understand that even if you do all of these things, you can still lose money. Bottom line, real estate is an at-risk investment. And feel free to type in your questions. We will take questions about your favorite metros at the end. There's a rapid fire section at the end where we usually talk about at least 100 cities. Feel free to plug in your favorite city. We will send out a recording of this event tomorrow. That recording is very important because it will include the deck and the spreadsheet. I'm going to say this again because you guys email me far too often. The recording that we'll be sending out tomorrow has this deck and the spreadsheet that I'm going to use today. All right, so why now? Why is data science needed today? You guys are not using data science and you're still making lots of money in real estate, right? Everyone's made money in real estate. Why do you need data science today? Well, the reason for that is in the last 9 years, real estate has only done one thing, gone up. A monkey with a dartboard could have made money in real estate in the last 9 years. I'm not suggesting that you're that monkey, but I think you see my point. It was extremely easy, right? That's changing. Here's why. Take a quick look at what's happening in the US. All of these articles that I'm going to show you are from the last week or two. So Las Vegas, down only about 0.5%. That doesn't sound like a lot, right? 0.5% doesn't sound, I mean, Las Vegas, come on, 0.5%. But it's 0.5% in a month. So that means 6% in a year. So this Las Vegas market, it's showing some cracks. And for the first time in 9 years, we're seeing something unusual. Prices are going down. But once again, 0.5%, no big deal. Okay, what about this one? Boise. Boise prices fell 3.5% in June. Once again, doesn't seem like a lot because it's like, come on, Neal, it's 3.5%. Okay, annualize that number. 3.5 multiplied by 12 would be 42%. Now, I'm not suggesting Boise is going to fall 42%, but 3.5 is a big number. But it's really small compared to Reno. So here's Reno, and Reno prices have fallen by 4.5%. And here is Phoenix, down about 5%, roughly. What about Austin? The hottest market in the United States has not seen any price drops, but I'm predicting that it will because this month it saw a massive uh, reduction in price reduction. So listings, basically 32% of all listings in Austin have seen price reductions, which means that if I do this webinar next month, there's probably going to be a price reduction happening in Austin, the hottest city in America. What about the city that I live in? I live in the San Francisco Bay Area, and the San Mateo County, which has a lot more stock than San Francisco County. San Francisco gets all the press, but San Mateo County actually has a lot more housing stock. This is stunning. In a single month, San Mateo houses fell by 12%. This isn't an annualized number, it's for 1 month. This is why you need data science. This is a market to be extremely careful of, and it's absolutely critical that you use data science because the data science that we use shows you fundamental strength. Warren Buffett says, when things go bad, go towards the companies that show the most fundamental strength. Go towards the bargains. Data science shows you which markets are still bargains. All of them are likely to fall. But you want to be in the market that falls 2 or 3%, then gets up, dusts itself off, and then zooms up another 30% in the next 3 years. You don't want to be in San Mateo, 12% a month. That's why we're doing this webinar. All right, time to get started. We use data science in many different ways. Today I'm going to show you the 5 simple ways to use data science to pick cities. Once again, this is critical with a recession coming up, but it works at any point of time. I'm also going to show you how we use it professionally. So you'll get a view at, okay, what does a professional company use and how is it different from what I'm going to teach you, right? So I call these 5 different methods real focuses. And my first real focus is population growth. When you are going to go into a recession, we believe that there's going to be a recession later this year or early next year, you want to be in a city that has very strong population growth because population growth is an awesome way to protect against recessions. So we want you to be investing in a pre-recession time in a city that has a minimum population growth of 10.6%. Now, unlike the other numbers in this presentation, if you've seen it before, this number actually hasn't moved much. So in the last 2 or 3 years. Why? Because US population growth is slowing drastically. 10.6 is a truly awesome number over this time frame. I'll explain this time frame and why it's 2011 and 2020, not 2011, 2022. But this is an awesome number in a country where last year our total population growth was 0.2%. It's the lowest it's been ever in the history of this country. So it's super important. The US is slowing radically. Population growth is your best line of defense. Now, here's the numbers, and I'll explain how you're going to find these numbers for any city in the US in just 30 seconds, right? So first, let's read the line. If a city is between 250,000 people and 1,000,000 people, then you want that city to have at least 10.6% population growth. The higher, the better. between those 2 years. See, look at the screen. It says 2011 and 2020. You might say, but we're in 2022. Yes, but the publicly available data today that you can get to in 5 minutes is between 2011 and 2020. And cities usually don't start abruptly losing population or slowing down. Their population trends tend to be over decades. So the fact that I don't have data for 2021 and no one has data for 2022 because we're still in the middle of the year, the fact that I don't have 1 year's data is not going to change anything for you. You're going to end up with the same list of cities as if I had, even if I had 2021 data. So don't worry about the fact that this data is a couple years old. Now, if the city is pretty large, let's say Phoenix or Philadelphia or San Antonio, San Diego, Los Angeles, big cities, well, they never grow as fast. So then that number, that 10.6 number, it actually drops. It drops down to about 7%. And that's still okay. If you want to invest in bigger cities, obviously they have benefits. They're job centers. But what if you want to take a little higher risk? And you want to invest in micro cities like Durham, North Carolina, or St. George, Utah. Well, in that case, you want to go into cities that have ridiculously high population growth. Why? Well, you're taking a risk, right? You're going into a smaller city. Shouldn't you get rewarded for that risk? Well, you get rewarded for that risk by picking a city with higher population growth. Now you've got some insurance because the city has such ridiculous growth that you can get insane increases in rents and insane increases in home prices. Now, before I show you where to get this data, I have a caveat, a disclaimer. And here it is on the screen. This number only applies to the rest of 2022, all of 2023. Do not use this in 2024. We used to provide a way for you to continue using the system in future years. We found that it didn't work. The big reason is 2020 has been the most crazy year in human history. 2021 has been the most crazy year in real estate. So we're seeing one crazy year after another. So what we've decided is, look, at the beginning of the year, just come to our website, multifamilyu.com, grab the new numbers, take it with you. Remember, this is not a subscription. We're not selling anything. You just come, take a year, take the updated number. So you can only really use this number until the end of 2023. At the beginning of 2024, we'll give you a different number. All right, so now before I go to the next one, I want to show you where to get population growth information for any city in the US. It's really simple. You simply type in population and the name of the city. In my case, I like using Columbus, Ohio for my my demos. It's not my favorite city, it's just a city that I like, right? Population Columbus, Ohio, but you could type in population Phoenix, Arizona, or population Reno, Nevada. It works. You click here, you hit enter, and you see this nice graph from Google. So currently, it looks like in 2020, the population of Columbus, Ohio was 889 and 79 people. Now, to figure out if this number, 879, is going to give you this growth. Remember, you want this groups. What happened here? All right, here. Remember, you want this 10.6% number, or you want a number higher than that? Well, how do you know how to get to how much growth there is? You see this upward curve, so that's good. But is it 10.6? Well, at the end of this webinar, you will receive an Excel spreadsheet. Here it is. You see the Excel spreadsheet? Yes. Anna, are we seeing the Excel spreadsheet?
Yes, we are.
Okay, great. So this Excel spreadsheet, you type in the number.
It might be better if you make it bigger, but okay. That's fine. I see you're using your landscape. Yeah.
Yep. There we go. How about that? There we go. So in the Excel spreadsheet, this is real focus one, population growth. You're going to plug in for whatever city you pick, right? I've picked Columbus, but you can pick whatever you want. You're going to pick in you're going to plug in the population 2020. So you see that 889079. Just type it in here, 889079, and then move the mouse. So you're going to move the mouse backwards until you get to 2011. And right there on the top, it says Columbus, Ohio, 779573. You see that? On the top right, 779573. So I'm going to type in 779573 and hit enter. And now you notice that this cell turned green because the population growth in Columbus was 14, which is higher than 10.6, right? We want to hit 10.6, but higher is better. So Columbus, Ohio, for just this one metric has done really, really well. So that's all there is to it. All you have to do is come here, plug in the 2020 number, which will always be on the screen, then move the mouse to the left, plug in the 2011 number, and green is good. If the cell turns green, that's really good. You're doing well on that particular real focus. Simple? All right, let's move on to real focus number 2. Real focus number 2 is median household income. You want to be investing, especially in a recession time, in a city that has very strong income growth. Because even more than population, income growth protects home prices from falling. Income growth protects rents from falling. So you're looking for income growth that's around 35.2%. We've made some adjustments on this in case you came last year, so you'll notice that. So this applies to cities of any size. So it can be a big city, a small city, a very small city. Now, if you're in a complete boonies, you're probably going to see numbers a little bit smaller than that. So keep that in mind, right? Now, I'll also show you where you find this number. But before I give you that, here's my disclaimer again. This number, this income growth number, only applies to 2023. Why? Inflation. We have massive inflation in the United States. This number will simply not work in a year from now. Because right now, the number that you're going to see is actually going to be between 2000 and 2019. See this? 2000 and 2019. And you're like, oh my God, the last one was 2020. This one's even worse. It's like 3 years old. The answer is it's public data. I'm going to show you where to buy data. And then you can get 2020 and even 2021 numbers. You can't get 2022 numbers right now. We're in the middle of the year. But you can get 2021 numbers and 2020 numbers. What I'll tell you is this. Income growth in most metros in the US doesn't change over years. It changes over decades. It's a very slow, smooth trend. You know, all of a sudden, you can't have Louisiana become California. That takes 4 or 5 decades. So what I'll tell you is you'll probably end up with the same list of cities, regardless of whether you use public data or you use paid data. I will show you where to get the paid data, but you'll find it's the same list. So let's talk about where do you find this information on this 35.2% growth? The answer is an amazing website called City Dash Data. Not City Data, City Dash Data. So I'm going to go here and I'm going to type in Columbus, Ohio. Remember my demo city? Not favorite, demo. And I hit enter, and now I scroll down a little bit so I see a bunch of pictures, and then I see these bars. And what I'm looking for is this section here. Do you see this? Estimated median household income. Let me make this bigger, 150%. Boom, boom, boom. There we go, 150%. And so I'm going to scroll down again. And do you see this section that says estimated median household income in 2019? Well, here's a number. And there's this number in 2000. I think you've guessed what you're supposed to do, right? You're supposed to drag the Excel spreadsheet over here, and you're supposed to grab this number, 57118, plug that in 2019, 57118, then plug in the 2000 number, 37897, and you notice that this number, this cell has turned green because the income in this particular city went up by 51%. How much did we need? We needed 35.2%, right? Higher is better, right? Not necessarily better, but higher is better. So obviously, this city, Columbus, has fared well on real focus number 2. Getting the hang of it now, right? Plug in 2 numbers, compare, look for green. If it's now, what if this number was 35? It wouldn't go green, right? Because 35.2 is our number. Now, don't obsess. Data science says close enough is good enough. So if it was 35 or 34, Columbus is still a good city to invest in. What you don't want is to be missing on all of the metrics. Missing a near miss on 1 or even a near miss on 2 is okay. But if you're missing on 3 or 4, why are you even using this spreadsheet? You could just go randomly pick cities. Moving on. Number 3, city number, the real focus number 3 in our list is median house and condo value. And as you can imagine, this is the number that's changed the most. So we're looking for 56% growth in median house and condo value between 2000 and 2019. Now, this one, I must hesitate and say it doesn't particularly protect you from recessions. It actually is useful for good times. Well, it still works though, because while we're about to have a recession and this metric will not in any way protect you from recessions, it will indicate how this city will do after the recession ends. Because the recession to come is going to be a very shallow one. So this gives us a sense of how the city will react after the recession. So it's still handy, still useful. Once again, my disclaimer, only apply this level of growth to 2023. Come back in Jan 2024 to the Multifamily U website, grab the new deck with the new number. All right, that's real focus number 3. Now, where is real focus number 3? Super easy. Remember, we were on the city data website and we plugged in Columbus, Ohio numbers. We just took the numbers from this line. Well, now we're going to take them from that line, right? So here, Columbus home prices were 173,300 in 2019 and 99,100 in the year 2000. So we go back to our spreadsheet, scroll a little bit to the right, plug in the two numbers. Let me see them again. 99,100. So we're going to plug that in here. 99,100. Boom. And then we're going to plug in here median house or condo value 173,300. 173,300. And boom, green cell. Yay, 75%, way above the level that we needed, right, for Columbus, Ohio. And you might say, really, all cities hit this? I mean, Columbus, Ohio is not some awesome city. Actually, Columbus is pretty awesome. Columbus is a city that I call the jewel of the Midwest. It's not my favorite city in America to invest in. We'll talk about those favorite cities later in this presentation, but it's a pretty darn good city. The reason I use a city in the Midwest, in the Rust Belt, as an example, is to point out that you can get great deals in the United States. They don't have to be in San Francisco or Austin or Seattle. There's a lot of choices out there, many good choices. All right, let's move on. The fourth predictor that predicts real estate profits is not crime, it's change in crime. So what you want to do is you want to look for a number, and I'll tell you where you're going to go look for it, and you want that number to be below 450. Most people believe that crime in the United States is increasing. That's not the case. Crime did increase in 2020, the COVID year. Kind of a crazy year, so that's pretty normal. And it sort of plateaued in 2021. But if you look at the last 2 decades, crime in the US universally has been decreasing. CNBC won't tell you this, neither will Fox News, but their job is to scandalize the news. Crime is reducing. So it's very important that you do not invest in a city where crime is flat or is increasing. You want a certain crime level, that's that 450 level that's on the screen in front of you, and you want that number going downwards at a pretty high velocity. So I would say, for example, if a city was at 650 and it's now at 450, well, that city is doing pretty well. The crime dropped 200, metrics. This is just a raw number. What you don't want is a city that is at 600 and has dropped to 560 and I'll show you where those two numbers are. Because that city, the crime's dropping, but it's dropping really, really slowly, much slower than the US. Right? Make sense? Now, the good news is this metric, the 451, is not going to change in 2024. So you can still apply this in 2024, maybe even 2025. Crime statistics tend to change once every 3 to 5 years. They don't change every year. So this one has some longevity. But still, I prefer that you come back in January 2024 and get the new number. Who knows what might happen between now and then for crime. Now, where do you plug that number in and where do you get it? First, let's talk about where you get it. Well, it's on the same page, that same city data page, but now you're going to need to scroll down a fair bit. So I'm going to go, oops, what the heck did I do? I think I dragged something and it disappeared. Here it is, it's back. All right, so I'm going to keep scrolling down, scrolling and scrolling and scrolling. I'm going to go past this table. I'm going to keep scrolling and scrolling and scrolling until I come to this section. Do you see this? Right? So you see this number here, and then you see this number on the right. I'll make it a little bit bigger. Right? Okay, there we go. House of the Dragon. I'm actually looking forward to that, Anna. House of the Dragon coming August 21st.
I
The
am
new
as
Game of
well.
Thrones. Yes, I'm looking forward to that. So right now, because I'm going to zoom out because this is actually going to be hard to explain if I don't zoom out. So sorry about going back, but what I'm trying to show you is this table here, this blue table here, is where you look for the crime numbers. You know, see the murders and the rapes and the robberies and the assaults. You're going to ignore all of them. You're just going to look at this last line, this blue colored line, right? And what this line is showing you is how this city, whatever city you picked, has progressed over time in crime. Remember, all cities in the US have seen, well, not all, but almost every city in the US has seen a reduction in crime. So that's normal. But what you want to see is a substantial reduction. So Columbus was way above the 450 level. So it was in the danger zone in 2006 and in 2007, but then it slowly started to drop. And by 2014, it was in a really good place, 423. Remember, 450 or below is a good number. And then it sort of bounced around because it's kind of hard to even be in the 400s, especially if you're a Rust Belt city. But then look to see what's happening now. It's continuing its drop. I can tell you why crime is dropping in Columbus. Columbus is becoming an expensive city and it's pushing out poor people. Now, it's very non PC to say this, but from a data scientist perspective, I hope you don't beat me up for saying this. Crime is correlated to poverty. Places like Malibu have much lower crime than places like Southeast Detroit. There is a correlation, and I'm simply using data science. So don't kill me. But as the city of Columbus pushes out poor people and brings in richer people, its crime is dropping. And you see that effect in 2018 and in 2019. I have no doubt that this will continue. So what you're trying to do is you're trying to use that Excel spreadsheet. Let's go grab that Excel spreadsheet again. And what you're doing is you're going to the right of the spreadsheet to this fourth section here. And what you're doing is you're saying, okay, what was the crime index in the most recent year? So for Columbus, I think it was 361, might be off by a little bit. And then what was that crime index 15 years ago? Well, it was more like 660, right? And these are not exact numbers. I'm just trying to move through this quickly. Wow, look at that. Any number over 100 is pretty good in terms of crime reduction, but 300, this city is going places. It's gone from being typical Rust Belt to being, ooh, wow, this is investment grade. So these are really good numbers. And so Columbus really aces real focus, number 4. All right. And now for the fifth and final real focus. And before I give you that fifth and most important real focus, so only the people watching this webinar will have access, plus some of our top investors. All right. Time for the fifth and final real focus. And that is, as you can imagine, job growth percentage. And this is bizarre right now. I have never presented a number anything like this, but obviously because 2020 was a weird job year and then 2021 was a weird recovery year, job growth right now in the US is pretty messed up, right? So I'm not saying that, well, maybe that's not the right word. Job growth in the US is pretty awesome, but it messes with the real focus system. So this 4% actually have had to divide it into two pieces. So, or maybe three pieces. So what I want you to look for is the city that you're investing in, it should have over 4% annualized job growth. That's 3% for big cities over a million like Los Angeles. And I'm going to show you where to find these numbers. The link is right there on the screen for you. Now the caveat here is actually even more stringent than the others. Only apply this 4% number to the rest of this year, to the first half of 2023, and then drop to 3% for the second half of 2023. Why? Because the market is normalizing. Because as the market normalizes, the numbers fall. If you try 4% in the second half of 2023, you might not find any cities to invest in. Who knows, right? So now let's talk about where to get this data. Well, straightforward. You're going to go to a website which is in here. There we go. So this is departmentofnumbers.com, a very funny, interesting website called departmentofnumbers.com. This is actually a government website, and they advertise. I guess the government needs money. /employment/metros. right? This is a very boring looking website, but it's absolute gold. It's an amazing website. I look at it all the time. I'm sort of, you know, unhealthily obsessed with looking at the numbers on this page because they're so, so important. Job growth is the most important real focus and the one that tends to affect your profit the most. So as you look at this, the first thing I would want you to do, and remember, you're going to get this link tomorrow because you're going to get this whole deck. And the Excel spreadsheet also has, this list link in it. So you've got it in the deck, you've got it in the spreadsheet, right? So you don't have to write this link down. Now, 1 year job percent change. This is the one that matters the most. This one actually I don't usually care about, but I'll explain to you why when I look at this. All right, so I click this twice. Once when I click at it, the most crappy cities in America come up. Sorry, but in my list, these are the worst cities in America. To be losing jobs at this point when the US is at 3.5% unemployment, you've got to have really bad prospects. Click again and some of the most amazing cities in the US come up. The challenge is that recovery from COVID has been uneven. So I'm
Neal,
going to
can you
point to
zoom
some
in,
of the
please? People are requesting if you could zoom in more, please.
zoom in, zoom in, zoom in. All right, let's do that. Let's zoom in. Boom, boom, boom. How about that? All right,
Thank you.
there we go. Let's do one more. Let's do one more. Perfect. So normally this list is very reliable and it'll become reliable again in the next 6 to 9 months. But right now the list is a little bumpy. Why? Because cities recovered from COVID at different times. So we see some cities at the top that we don't normally see. Gambling cities are at the very top, Atlantic City and Las Vegas. Why? Because gambling is recovering at this point, so late recovery. But then you also see superstar cities, Dallas and Orlando, always at the top of this list. We never see Flagstaff, Arizona, but it's there because it recovered late. We do see cities like Northport, Nashville. We see Austin, Atlanta. We don't see Blacksburg or Waco at the top of this list ever, so keep that in mind. There are two cities here that are very odd, and I want to warn you about them. They are Odessa, Texas, and Midland, Texas. These are oil cities. They're usually either at the top of this list or the bottom, so they are the most dangerous cities for real estate investment in the US. In my mind, unless you truly understand the oil market, stay away from these. But other markets that show up pretty often, San Diego shows up, Houston, San Francisco, pretty often, though not as often as I would like. Since I live here, the city that shows up the most often at the top is Provo, Utah. So most consistently, since I've been teaching this webinar for 7 years, this is the city that shows up the most often. But there's lots of other interesting cities in this list. One thing to remember is you want this number, see this number here, you want it to be above 4. So that'll take you almost halfway, well, maybe 40% of the way down the list. Do know that as each month passes, the percentage of cities that are going to be above 4 is going to keep dropping and dropping and dropping. In normal times, we want this number, this 4% number that I'm showing you. Oops, why does this change? This 4% number that I'm giving you to be above 2%. So in normal times, 2%. So each year when you come back to our website, you grab the new spreadsheet, you grab the new data, you'll notice this number is going to normalize. 2% job growth is really the holy grail. Because when there's 2% job growth in a particular city, there's a lot of bidding on real estate assets. 3% is even better. 4% is amazing. 5% is just rock star. And right now, there's dozens and dozens of five-star cities. That's simply because of that one-time COVID adjustment. But one thing I can tell you for sure, the cities at the top of this list are generally better than the cities at the bottom. Now you'll see occasionally you'll see, well, like Santa Fe in New Mexico is at the top of the city list. Is it an awesome city? The answer is no, because when you go through the other real focuses, Santa Fe is not going to do well, right? So you're going to reject it anyway because it doesn't pass the other 4 tests. It does for jobs simply because it's a late recovery city. And right now, late recovery cities look pretty darn good. So do cities that just have a lot of jobs, like, Austin, Texas is not in here because it recovered late from anything. It was the first city in America to recover all of the jobs lost to COVID. But it's just it has a lot of jobs, so it's at the top of the list, and probably will be at the top of the list 6 months from now, 12 months from now, and 18 months from now, because it's simply the most powerful economy on in the US for the next 10 years. So it's nice to see some interesting ones. So I'm going to kind of walk you through this list. And of course, you guys are going to ask me about 100 cities at the end of this webinar, which is in a few minutes. And so we'll talk about more of them, right? So Dallas, terrific city to invest in. This number is real. It has nothing to do with COVID. Dallas is seeing explosive job growth. Orlando's doing really, really well. A lot of people want to go see Mickey Mouse because they haven't seen Mickey Mouse for 2 years. So take a look at those. They're very strong. Athens is an interesting city. We've noticed it very fairly recently, and we bid on a student housing asset there and lost last year. And I think it's a terrific city to look at. Atlanta is amazing, absolutely damn amazing. From time to time, I think it's going to go down, and it just stays up there in the list. So terrific city. Atlanta Metro is a terrific place to invest in. So is Austin, even though I showed you that home prices in Austin are falling. You might say, why, Neal, are you investing in Austin? The answer is when I look at all the real focuses, plus I look at my professional level spreadsheet, I just don't see anything like Austin. It's just its numbers are off the chart. So I'm just going to take that 5%, 7% dip. It's not really going to affect my rents as much because there's so many people moving into the city, and I'll be okay. Does that make sense? On the real focuses, Austin is going to crush just about any city in America. You just have to look at all five of them.
You
All
skipped
right.
over Nashville, Tennessee.
What's that?
In Nashville, Tennessee, you skipped right
Yep,
over it. I
yep.
know it's one of your
That's
favorite
another
ones to
one.
talk
It's
about
a
as
city
well.
that yeah, it's a city that I like to criticize, but I must say this. I always think Nashville prices are about to fall. I thought that 3 or 4 months ago. I checked it last week. I'm still not seeing any evidence of prices falling. So Nashville, Tennessee, and Denver, Colorado tend to surprise me a great deal, but are definitely two strong cities to invest in. If I was investing in Tennessee, though, I'd probably invest in the secondary city of Knoxville, Knoxville, rather than Nashville, because Nashville is a little bit on the bubbly side. But these are good cities to invest in. For Californians, Riverside is a fantastic choice because people are running away from Los Angeles to Orange County and running away from Orange County towards Riverside. So you're going to see terrific growth there. Sacramento is one that I'm very careful about at this point in time. I think Sac has had an amazing run, a very profitable run. We were screaming about Sacramento in 2017 and people didn't listen to us. But at this point, watch out. I think Sac falls the most in California, even more than San Mateo. Let's see. Other interesting cities, Anna. You've got lots and lots of your favorites. Let's see. What else is in
Well, I think Lake
Cape
Charles
Coral?
is worth mentioning because it is one of those Odessa. It is one that could fool some people.
Yes, yes. We find Lake Charles to be a very dangerous city. Lake Charles had a massive increase in investment because of LNG, or liquid natural gas. As you know, Russia is turning on off the pipelines, so all European cities are scrambling to build LNG terminals. The US's biggest LNG terminal happens to be in Lake Charles, so it saw a boom. But it's a one-trick pony. At this point, we're not sure if it can sustain its jobs because it's just a terminal. The jobs are there, but once it's completely developed and expanded, I think those jobs are going away. So it's kind of like Odessa and Midland. It's dangerous.
Yeah, but it
But
has more of a propensity for hurricanes as well. It's gotten hit
that's
very
right.
hard
Yeah,
twice in a row, whereas I
twice in
don't
a
think
row.
Odessa and Midland have that.
Yeah, it's been hit. Direct hits by hurricanes are actually more rare in the U.S. than most people believe. Cities will have hurricanes, but they're not direct hits. This city has had two direct hits, so not good at all. Well, the
Yeah.
city I like to talk about is Cape Coral and
And
also
we had
its
somebody
sister
asking
city.
about Cape Coral. So
There you go.
why don't you talk about that one?
So Cape Coral and Fort Myers are part of a corridor effect that starts in Tampa and then runs through Sarasota, Punta Gorda, Port Charlotte, and then goes down through Cape Coral, then Fort Myers, and then sort of ends in Naples. So that is a corridor. I think it's about 300-ish miles, maybe 250 miles long. That starts in Tampa and runs downwards, and that is an absolutely explosive area. Um, Cape Coral is expensive, so maybe look in Punta Gorda, which is a little north of Cape Coral. Port Charlotte is even slightly cheaper than Punta Gorda. We're looking in Port Charlotte, so those are terrific markets to invest in. If there's one state that I would pick for this year, it's Florida. There's no doubt in my mind I'd pick Florida, but I'm not at all bullish on super expensive parts of Florida like Miami or Palm Beach. I think they've had a great run. I don't think that they're at a huge risk at this point. I see no evidence of price drops in Miami, but I do feel that they're a little bit risky, that they're just not as good as they were maybe a year and a half ago. All right. Now, before I give you more cities, here's questions that I know you're going to ask me, right? First, where do I get the spreadsheet and deck? You're going to get a replay. Most likely it's going to be tomorrow. It might slip into Saturday. Look carefully in the replay email. It's going to have a link for the deck, and it's going to have a second link for the Excel spreadsheet. That's it. Grab those. It's yours. Use it as you like. No subscription. Now, the next time you have to do something is January 2024. So you'll go to this website. You'll sign up for the same webinar. You don't have to watch it again. Maybe you do, maybe you don't, and simply grab the updated deck and the updated spreadsheet from the replay that you'll get after the webinar. Now note, this data is always free. If anybody tells you that it's not, they're bullshitting you. If you want to pay us, just pay it forward by sharing the data. And please also join us for 50 free knowledge-driven power-packed webinars at Multifamily University. We hold a webinar roughly every 2 weeks. And we have some terrific speakers and terrific webinars coming up. More geeks, dorks, nerds like us presenting amazing concepts. And with that, I'd love to open it up for questions.
Yes, well, just to clarify, because people are asking about a professional Excel model that you talked about. I think you're talking about professional subscriptions that we pay for.
Well, what I wanted to do was very briefly, show the model that we use internally. Now, I can't give that model to you.
Yes, it's not going
that
to happen,
model
people.
has, it has data from paid sources. But what I might be able to do is to kind of flash it on the screen so you kind of see what happens when a company professionally uses this data, right? Because like, are you using this data? The answer is yes. Everything that we just taught you and a bunch of other things are on the screen in front of you right now, right? So as you can see, as you get, as you manage $1 billion of people money, you're going to be very anal about every area. So, but the bones are the same, right? So you see home price ranking, you see population, you see a lot of the same stuff. As I go to the right, you'll see job growth data, you'll see unemployment data. A lot of it is the same. Now, we look at more statistics. We look at 3-month job growth. We look at 12-month job growth. We're looking at lots and lots of different slicing and dicing. We're looking at single-family permits and how multifamily permits for so that we understand what's the supply coming into the marketplace. And then, of course, on the right side in blue, you see wage increases, etc. Right? So our goal, and by the way, please answer the poll that's on the screen that Anna's throwing up, because this is how we can tell how to tailor these webinars towards you. But on the screen, you can see this is the end result. And do you notice that at the bottom of the screen, there are tabs? We do this every month. Yes, all of the data that you're seeing for 300 metros is updated every damn month because we're professionals. I'm not suggesting that you do this once a year. It's just fine for you, right? Now, I can't give the spreadsheet to you because, as I said, we're paying for data and I don't want to get into trouble. But nobody can stop you from screenshotting what's on the screen in front of you. Nobody can stop you from screenshotting what is on the screen in front of you. And I do want to point out that some of the cells that are in blue or in yellow, we're not suggesting that you invest in those. They're great market to invest in. We just have them in this color simply because we are looking to invest in those markets or have invested in those markets in the past.
Yeah.
Right. So we like Rapid Cities, SD, we didn't invest in the city, but we tried like hell. That doesn't make it any better than any other link any other city on this page. So ignore the colors. They don't mean anything. But obviously, this is today's list. And as you can see, the number 1 city in the list is in that corridor. The number 3 city in the list in that corridor. The number 4 city in the list in that corridor. Do you see a trend here? Number
Number
9, number
7,
10
number 9.
in that corridor,
Yep.
right? So there's obviously
Yep.
there's trends. We don't just look at cities. Looking at cities is sometimes, counterproductive. We look at what's happening in areas. Often those are corridors if they're tied to a freeway, and sometimes they're circular, right? So this is where we are seeing strength. And we don't care about the next recession because recessions end. Our goal is to look at cities that fundamentally are super duper strong. Because whenever that damn recession ends, those cities will bounce back a lot faster. Now,
Yep.
somebody mentioned Port St. Lucie is
Yeah,
not on
it's
that
not on
corridor.
that
That's right.
corridor.
You
It's
didn't
on the
mention that
it's
one.
on the opposite coast.
Yep,
It
it's on
is
the other
there
side.
is yeah, it's between yeah. So you are right. It's on that corridor, but it is a very strong city, and it is got a relationship with Orlando and Tampa, which is on the other side. So we look at all of these things. Florida is a great state right now.
That's
Let's get
right.
into some of the questions.
Yeah, let's do it. I like this one. This is a very geeky question, so I'll take it first, right? So Eric says, the keys that you provided, were they the output of a multivariate regression? The answer is absolutely. This is statistical analysis. What is the point of giving you this information if I didn't apply it to, to previous results and backtesting? Yes, the answer is yes.
What do you think of tertiary markets? The example is Corpus Christi.
I love tertiary markets. We made a bid, 2 months ago, Anna, in Corpus
Yeah,
Christi?
we have too many people that want this model, Neal. Maybe you could throw up a different slide because you guys, we're not going to be sharing the model, the
No,
data,
we can't
but
share a
just,
model that
we're
has
not
paid
sharing the
data in
model.
it, guys. We do not want to get sued.
Yeah.
But my
And the
point is
model
this.
itself is not shareable either. We put years of work into what we do with it. So we do have a free model, and you can
Well,
do a
all I
lot with
want to
that.
say is this. Just use the real focus system that we gave you. You're going to 80-90% of the time, at least 80% of the time, end up in the same damn cities as us, right? We are managing people's money. We have to look at it at a completely different level. But the real focus system by itself is powerful enough to make you to get you into the top 1% of all investors.
Why don't you put up the slide that tells them, their next steps? Because we still have people asking about how they get the real focus spreadsheet. So I think that would be a good one to keep up. All right, let's go through some of these rapid fire. By the way, if you want your question answered, there is a thing called the Q&A box. The chat box is for letting us know you have issues with your screen or those types of things. I heard Las Vegas had some bumps come in on their performance this month. Thoughts?
It's soft. Las Vegas is soft. So that is why at the very beginning of the webinar, I showed you 6 cities that I'm seeing softness in. So Reno, Austin, Phoenix, Las Vegas, Boise are cities where I'm seeing softness. In the San Francisco Bay Area, it might be about to fall off a cliff. So that's not considered softness. Now notice that on the real focuses of those cities, Phoenix and Austin are still ranking very well because I don't really consider 5 or even 10% drops to change fundamental business making decisions. If the city is very strong, it will bounce back. Both Austin and Phoenix were really too bubbly for single family. Now, keep in mind, when cities that have huge population growth, if they start seeing less houses being constructed, so a lot of housing permits in Austin and Phoenix are being pulled back, then 2.5 years from now, and we're patient people, you're going to see a shortage of housing. So that's what we're banking on for Phoenix and Austin.
What about a city that is not on the list? I think this is for the job growth. Does that mean it's lower than the percentage we're looking for?
Well, if the city is not on that certain page, it might simply be that it's very small. So you can go to the bls.gov or Bureau of Labor Statistics site, not a very friendly site to use, by the way, but if you muddle through it for about 30 minutes, you'll find the city and you can check out its job growth. If it's not in this list, it doesn't mean it's not a good city. It simply means it's probably too small. There's also a few weird cities that do not report job statistics the way that other cities do. So there's a couple that are just missing for no reason at all. And I found that it's because they don't report the same way, but they do show up on the BLS website.
In the past, you had told us to add a percentage to certain marks. Has that changed? Also in
Yes,
reference, so go answer
yes, it
that part,
has.
please.
I found it didn't work. What I was trying to do was to basically not force you to come back once a year. That was a mistake on my part because I gave you basically a guesswork on what should you add to each number the following year. Then COVID happened. Those additional numbers made no sense. Then recovery from COVID and the greatest real estate year in history happened. And the numbers didn't make sense again. Now I've resolved that every damn year in January, we'll just repeat the webinar, change the numbers. You can come pick them up.
Yeah, and you just watch the replay and get it for free. They'll always be free. Also in reference to the crime index, previously you gave a lower number for tertiary markets. Has that changed?
No, it's not. So if you're going to a true tertiary market, true tertiary like St. George, right, 200 miles away from anything else, Idaho Falls, instead of using 450, you should be using 350. True
Uh,
tertiary only. If a market's 50 miles from Phoenix, that's not a true tertiary.
do you know if the Department of Numbers city reference refer to metro, including suburbs, or is it only within city limits?
You know, I've heard two answers to that question, so I'm just going to say I don't know for sure. The data to me indicates that they're doing it at a metro level.
Okay, we are going to go through a bunch of cities, and then we'll go back to non-city questions. Are you ready, Neal?
Mm-hmm.
And then we'll do some cities
Yeah.
again at the end.
Yeah.
Okay, San Antonio.
Terrific city. I love investing in the city that is closest to a supernova. Phoenix is a supernova, so I invest in Mesa and Avondale. Austin is the biggest supernova in American history, and that's why I'm investing. Well, maybe the second biggest. The San Francisco Bay Area really was the biggest 4 decades. Austin today is that big supernova. Nearest big city, San Antonio. More profit to be made in San Antonio. Austin's just sexier.
Two from the Central California, Visalia and Madera.
So Madera is terrific. So my personal portfolio, the largest city that I've ever invested in is Madera. I currently own 12 properties there. It's a terrific market. Once again, I don't like investing in the primary market in a certain area. Fresno is that primary. Madera is 22 miles away. Has a lot of new homes, which means less maintenance. And so I like the Madera market. Visalia is a challenge. I've tried to look at it before, and I felt like the complete lack of jobs of anything except for the, on the agriculture side, it always keeps me away from Visalia.
Indianapolis, Indiana.
I think Indy's really doing well. I believe that Indy was a late recovery, so it really hasn't seen the rent growth that it should be seeing. So there's juice there for rent growth that may not be there for many of the other cities. So I think it's a strong marketplace. There's a lot of investment going into Indy. I would just say that you have to be careful in places like Indy. There's a lot of high crime areas, so be careful when investing in Indy. Don't try and invest in a truly discounted submarket.
Phoenix market, both for single family homes and multifamily homes.
Well, single family, you saw our prediction. We think Phoenix prices have to drop. They have been way, way, way too hot. That doesn't have anything to do with the quality of the Phoenix market. Phoenix is in 2022 is different from Phoenix in 2007. This is a highly diversified market. I'm just not sure if now's a good time to buy. Maybe wait until there's a 10% drop and then buy. I think for the multifamily people, prices are already beginning to adjust, so you're in a good place.
Yeah, no, we bought land there, but we bought that land there years ago. So we're getting the benefit of the increases that have happened since then.
Yeah, I do want to add that I like Phoenix outlying metros more than Phoenix City itself. So Mesa, for example, is about 25 miles to the southeast. Avondale is directly west, so it's about 20 miles directly west. I like those places more than Phoenix itself. I think people are overpaying in Phoenix.
Okay, KC-Mo, and especially in terms of development, do you think it's if there's oversupply there?
Did you say KC-Mo?
KC-Mo.
No, we don't think there's
Kansas
oversupply
City,
in
Missouri,
KC-Mo.
that
Oversupply is 3 to 4% of stock. KC-Mo is at 1.5% of stock. So how could it be overdeveloped? No, it's not even close to being overdeveloped. I think it's a good market. So I am known for not liking Missouri as a state, But as I said earlier today to Anna, Casey Mo, well, that's
Mm-hmm.
Missouri.
Yes. Corpus Christi.
Yes, definitely. We are looking to invest in Corpus Christi. I think Corpus Christi is a very underrated market. A lot of people do not invest in Corpus Christi because they think that it takes a lot of direct hits from hurricanes. That's the big fear. My data shows that Corpus Christi has only been hit by a hurricane direct hit once, one single time. That's because hurricanes don't come that far east. Oh, sorry, west. So if you look at the top 15 hurricanes that have hit the US in the last 50 years, only one of them reached Corpus Christi. Unfortunately, that was a direct hit. So I think that this is a market that is underpriced because people think it's going to get hit as often as Miami. It's not.
Let's see. What is a tertiary market, Neal?
Tertiary market, in my mind, a true tertiary market is one that's several hundred miles away from a major job center. So Idaho Falls is a couple hundred miles away from either Salt Lake City or Boise. Those are major job centers, right? So it's a true tertiary market. Um, St. George, Utah is a couple hundred miles from either Las Vegas or Salt Lake City. So that's again a true tertiary market.
Okay, now we're going to go back to non-cities. We'll get back to cities in a minute, but we're going to focus again on questions that are not specific cities. How does eviction data and foreclosures, how do they influence the ranking of a city?
Currently, we are not using them because eviction rates in the United States for multifamily, they're basically zero. For single family, they're very close to zero. It takes an extraordinarily long time for eviction rates to go up. So we're not factoring them in simply because we're not seeing any difference in our data.
What is a good free source to get accurate income at a property level? So 1, 3, and 5 mile radius.
Neighborhoodscout.com.
No, free source.
Well, it's $39. I'll think of that as free. You have to spend some money to make money.
Yeah, we love Neighborhood Scout. And there was somebody else asking, there was another question asking about where do you get the neighborhood data? We recommend Neighborhood Scout. It's a bargain.
Neighborhoodscout.com. Amazing data.
What is your opinion on Section 8 subsidized housing programs?
I don't like it.
What about cities that have rent control? I think somebody mentioned Orlando is voting on rent control.
Yeah, so my honest answer is I think rent control is seen to be like this evil thing that will completely destroy a city's prospects for landlords, and it's really not true. I think every city gets looked at where you kind of look at, and you brush it and you say, oh, okay, well, this city is now useless because of rent control. The truth is there's reasonable rent control and there's batshit crazy California rent control. So as long as your city is not as batshit crazy as California is trying to be, which is basically they implement rent control and they don't get exactly what they want, so they pass it just so that next year they can take the next step, and then the following year they can take the next step. Stay away from that kind of craziness. But there's a lot of places where we have seen absolutely no impact. Like Portland, for example, has rent control, but it's not crazy rent control. They're saying prices can go up by 7% a year. That's one of the reasons why Portland hasn't completely exploded, but 7% is a pretty good number. Maybe not in the last 12 months, but normally that's a pretty good number. So look at what the goals of the local legislators are. If they're simply trying to cool down a market a little bit, that's usually not a bad thing. Florida is a red state, and so if they're looking to do rent control, it's going to be pretty gentle. I wouldn't stop investing in Orlando.
Your analysis does not factor market risk due to natural factors like floods, fires, hurricanes. How are you factoring that in these recommendations?
The short answer is that I naturally stay away from places like Northern California that, fires burn down thousands of houses. I see an inherent risk in Florida. We're very, very careful with flood zones in Florida. We think that the 10-year time frame for Florida is very dangerous. So is Phoenix. So, there are markets that we see either at extreme, flooding risk or extreme risk in terms of, heat. Phoenix, Las Vegas, and Miami, especially being those markets. So we are simply looking to invest in those markets in the short term.
Let's see. How can I find approved permits in the pipeline? Is there any website for that?
Yes, but it's not free. It's CoStar.com. It is an expensive resource. Finding and getting permit information for that many different websites, for that many different markets is an expensive endeavor. So look up CoStar.com.
Somebody's asking, which property management company do we use? And another person is asking, how do we find property management, or how does one find property management companies once you found your city?
Those are for Anna.
Oh, all right. Well, we don't use a single property management company. We use the best property management company within the metro and specific neighborhood that we're investing in. We have a stringent set of criteria. We have about 60 different questions we put them through. We're very data oriented, so we only go with very, very tech savvy property managers. We fired them that don't want to fill out our data on a weekly basis, because as you can imagine, we, as asset managers, we need to have our fingers on the pulse of the community. And that generally requires more than them just handing us a report. So I'd say very tech savvy. Now, how do you find them? Well, you can look at the property managers that are listed on listings. So you talk to your broker, first of all, find out which property managers they recommend, and then you look at other listings and you say, well, who are the top property managers in this area? And then you make a list and you go about interviewing them. Let's see. You ready to go back to some other questions? Let's see.
Yeah.
Cities. Clarksville, Tennessee, north of Nashville.
Still benefiting from the Nashville halo, so a better buy than Nashville itself.
Virginia Beach, Virginia.
Don't know enough.
San Diego.
Yes, San Diego is a rare Californian market that we think is it's like Austin. It has tremendous long-term growth. It is the safest market, one of the safest markets in the United States for climate change, which you may not care about climate change or even believe in it. It doesn't matter. The people that have billions believe in it. That's all that matters. You and I, our thought process may not matter. The people that write the big checks think climate change is real. And so San Diego is getting a lot of investment. So I think it's a terrific market.
Portland, Oregon.
Sorry, one more time.
Portland, Oregon.
I think it's a strong market. There is a regional effect happening in the Pacific Northwest, Seattle kind of being the center of it, but Portland's also benefiting. So Portland and Seattle are kind of egging each other on. So I think it's a good city to invest in. Also, possibly we could see price declines there, 5 to 7%, but I don't think that should affect your long-term investing goals.
RTP area.
So
Raleigh, Durham, North Carolina.
I'm going to answer two questions in one. Somebody said, we believe that Raleigh could become the new Austin. Well, I'll say something a little bit different, but I think you'll understand it. I believe North Carolina is the new Texas. So the state, the entire state is becoming a powerhouse. And obviously in that state, the biggest city is not Raleigh, it's Charlotte, but the one that's the most advanced is Raleigh. So if you look at Texas, Austin's actually the fourth largest city, right? Dallas and I think even Fort Worth is larger than Austin, so that's the fifth largest city. But it's that ultra hot city. Well, in North Carolina, you now have 4 and possibly 5 ultra hot markets, with Charlotte being the largest market, but Raleigh being that Austin type market. So I think it's a statewide effect.
Oklahoma City, Oklahoma.
I think it's good. I don't like Tulsa much because Tulsa never seems to grow in population, but Oklahoma's good. I think in the past I've stayed away from Oklahoma because of oil swings. The city is oil dependent. But my fundamental beliefs are the next 10 years, oil is going to make an enormous amount of money and then not make much money at all. I wouldn't want to be caught dead in Oklahoma 10 years from now, but I don't mind investing next year.
Do you look at the type of jobs when looking at job growth, service, like service sector, healthcare? And if yes, where do you find such data?
There's a lot of data available. I mean, city websites often have data about the splits. There's many other places. So, the type of jobs a city has is not data that is very hard to find. Even City Dash data has it. If you keep scrolling down, you'll see a pie chart that shows the kind of jobs. I'm very, very partial to technology and healthcare jobs. Healthcare brings stability, technology brings money.
Do you think rent growth will hit a ceiling due to wage levels not keeping up with inflation?
It already is, but the answer is it depends. Class C rent growth is more likely to hit ceilings than Class B and Class A. It also varies by market and by property. There are properties that are $150 below market. What ceiling, right? You're below market. If the property is at market, yes, there are lots and lots of markets that we are seeing challenges with Class C, not so much with Class B and Class A.
Why don't you like Missouri?
Um, just look at the state's history in terms of the real focuses. Also, higher levels of crime than most other places. Short answer is it's not that I don't like Missouri. That's not the accurate representation. The truth is, I like other places better. That's what
Mhm.
data science is. You don't pick based on your emotions. Missouri is beautiful. You pick based on data science.
Please talk about water shortages in Phoenix. Will it cause real concern for investment there?
It will, but it's too soon. Phoenix is a big city with a huge amount of money. They have the ability to make changes, but I think that in the 15-year time frame, because of something known as ESG, I'm not going to go into that, something known as ESG, it'll become harder to invest in Phoenix, and that will cause prices to fall. We're a long way away from it, though. Climate change is a slow moving thing. It's something that I worry about a great deal. I've even done a webinar, since lots of climate questions are coming up. On multifamilyu.com is a webinar about the destructive impact of climate change on real estate. If you want to watch it, check it out. It'll give you a lot
It's
more
free.
details.
Yep.
It's free. All of our content is free. It's meant to be given away. Bottom line, though, is I'm watching Phoenix carefully, and I wouldn't invest in Phoenix 10 years from now. But it takes a long, long time for climate change to wind its way into real estate profits.
Which are the top 5 cities for new development of apartments or build to rent?
Hmm, that's a very, very difficult question. I would say San Antonio for sure because it's that second city near Austin. So I would definitely pick that one. I like that Florida corridor.
Yeah.
So we're investing in Punta Gorda slash Port Charlotte, but there's a lot of other interesting markets in that area. There's one market that we didn't show you, but it's called Rogers. I'm not a huge
Mm,
fan of the state of Arkansas, but I'm a huge fan of the city of Rogers, Arkansas. So you might want to look at that. And that one actually, you may not even need to develop anything. I think you can just buy things in Rogers, Arkansas for reasonable prices. So I think all of these cities are quite interesting at this point.
let's see. Well, we are just about at the end here, Neal. I'll have you just
Mhm.
spin through and answer 3 more questions.
Okay, all right, let me take a quick look. Neil says ESG is such a scam. Yes, my friend, it's an amazing scam. Who cares? If $700 billion is going to be invested based on a scam, you need to pay attention to it, even if you know the truth that it's a scam. Let's see. Pittsburgh, Pennsylvania. I'm always disappointed by Pittsburgh. I think it's an amazing city, one of the great cities of America. Just never seems to do as well as as I would want it to be, right? So it's just one of those perennial underperformers. So sad to say this, but it's the truth. And Neil, I'm not beating you. Well, the key thing is ESG is a scam, but it's a successful scam. So it's important to follow it. All right. So Greenville, South Carolina. Love it. Love it. I absolutely love that city. I think it has great, great potential in the future.
Okay,
Albuquerque,
one
New
more.
Mexico, doing okay. I think Albuquerque is pretty good. Don't
Yeah, I
overpay, but
like
I think
Albuquerque.
Albuquerque is a pretty good city to invest in.
I like
Um,
Albuquerque.
I'll take one more. Umesh says, who should I contact for 1031 exchange info in the up and coming fund? That would actually be Anna Myers. She is our 1031 expert. So you're welcome to connect with Anna at grocapitus.com. Just make sure you know the right spelling of Grocapitus. It's on the bottom right of the screen.
So since
Um,
we've done all those
can
questions,
I
we've
take
got
one
it.
more? Because this is too good for me not to take it.
Okay.
Why are prices in Florida not going down? West Palm Beach, Fort Lauderdale. What cities do you invest in Florida? Well, I've already told you I don't invest in West Palm Beach or Fort Lauderdale or Miami because prices there could go down and are likely to go down, just not yet. Florida is doing really well. It takes time for these things to happen. Real estate price reduction is a very slow moving process. I do think that the other side, Sarasota, Cape Coral, Fort Myers, is better, though I wouldn't be surprised to see prices go down there by 5%.
Do you see Grocapitus doing longer term holds for long term cash flow generation?
Yes, and it's simply because I'm getting more gray hair, and as ever, youthful, but I'm getting more gray hair, not grow hair, gray hair. So we tend to want longer holds as we get older.
All right, Neal.
All right, this is great. I know you guys are still firing questions, but we usually tend to close the webinar around 6:15 Pacific time. It's 6:20. So thank you all for attending and keep coming. There's a bunch more webinars coming later this year. Thanks, everyone. Bye-bye.
Thanks, everyone.